Nebius is trading at around 219, but there is no meaningful PE for 2026, 2027 or 28 for that matter. The first normal looking earnings multiple in the analyst estimates is 2029 at approximately 20.6. At the same time, Nebius is growing revenue at more than 400%, spending over 11 billion on capex, and raising huge amounts of both debt and equity in order to fund the build-out. So I don't think that the right question is whether Nebius looks cheap on a PEG ratio today. There isn't a useful PEG ratio, in fact. The earnings estimates explain why I would not force a normal PE or a PEG framework onto Nebius today. Consensus EPS growth is negative in 2026, negative again in 2027, and in 2028 for a change it's slightly negative. Those are not stable earning numbers that I would use for a normal PEG ratio calculation. So for the next few minutes I want to ignore PEG and forward price to earnings completely and look at three things instead. How fast the business is growing, how much capital that growth requires, and how is Nebius funding it exactly. Nebius generated approximately 1.36 billion in the latest 12 months. That's up about 443%. For context, the 2024 figure shown here is only about 91.5 million, and 2025 reached almost 530 million. So the growth is anything but subtle. The company is scaling extremely quickly, but the revenue growth by itself does not tell us whether the economics are working just yet. The operating business is still losing money. Operating profit over the latest 12 months was negative 669. Nebius still reported about 62 million of consolidated net income, but notice the 931 figure of non-operating income above it. So I would not look at the positive bottom line and conclude that the core business has already reached normal profitability. The important question right now is cash. Nebius generated around 5.2 billion of operating cash flow over the latest 12 months. 5.9 billion came from changes in unearned revenue. That means that customer payments received ahead of revenue recognition are providing a huge amounts of cash today, so I would not treat the 5.3 billion as normal underlying cash generation. And then we get to capex. Nebius spent roughly 11 billion over the same period, and that leaves free cash flow reported at around negative 5.9. That is the central trade-off in the Nebius story. Extraordinary growth, but extraordinary amount of capex going into the infrastructure behind it. You can see the build-out directly in the asset base. Net property, plant and equipment went from under 900 million in 2024 to about 6.5 billion in 2025. And in the latest 12 months we have just under 15 billion. So the capex is not an abstract accounting number. Nebius is rapidly turning financing into physical compute infrastructure. The next question is, where is this financing coming from? Nebius is funding this build-out with both equity and debt. Over the last 12 months, it raised about 7.5 billion of long-term debt and roughly 6.1 billion from issuing common shares. So total cash from financing activities went up to about 13.5 billion. And the share count matters here as well. Shares outstanding increased from about 236 million at the end of 2024 to roughly 272 million in the latest period. That's about a 15% increase. Nebius still has around 8 billion in cash. Long-term debt is about 5.5 billion, and only 47 million shown as the current portion of that long-term debt. So the company is not sitting here with no liquidity while it builds. Cash roughly offsets the conventional debt balance today. But the important point is that the position was created while Nebius was still raising a lot of new capital. The build-out still needs to produce the earnings that investors are expecting later. Now we can do something finally that is useful with the 2029 PE. At a share price at around 219 and a 2029 estimated PE of just about 20.6, the analyst estimates imply roughly $10.6 of 2029 EPS. Now if we hold that earnings estimate constant and change only the multiple, then we see at 15 times earnings the shares would be roughly 159. At 20 times earnings it would be 212. At 25 times earnings it would be around 270, And if we add a 30 times multiple, then the share price would be around 320. This is not a price target, it is a sensitivity analysis, but it does tell us something very important. If Nebius reaches the current 2029 earnings estimate, and the market values it at around 20 times, the implied share price is actually below today's price, which I don't believe it would happen. Nevertheless, at 25 times earnings, we have around 21% of total upside from around 220 levels that are current, before even considering how long we actually have to wait. For a much stronger upside though, Nebius either needs to beat the current 2029 earnings estimate or still command a very high earnings multiple once the business is much larger, which I believe is the base case. The bull case is powerful. Revenue is growing more than 400% per annum. Nebius is building a huge asset base very quickly. Customers are providing substantial upfront cash, and the company still has 8 billion of cash. If that infrastructure is heavily utilized and revenue continues scaling, then today's capex can turn into a much larger earnings base by 2029. And if consensus is too conservative, which it most probably is, the upside changes very dramatically. The bear case is that the market is already giving Nebius credit for a lot of that future success. Free cash flow is still around negative 5.9 billion, capex is more than 11 billion, the company raised billions through debt and new shares as well. And even if the 2029 earnings are achieved, a normal 20 times multiple does not create meaningful upside from today's price. So growth alone is not enough. The earnings produced by this infrastructure have to be much larger to justify both the capital raised and the valuation that people are paying today. So I don't think that Nebius is a stock that you can value properly using any metrics today. The earnings are too unstable and the company is still in the middle of a massive investment. What I do like is the growth. Revenue is scaling incredibly fast. The asset base is expanding and the balance sheet has a lot of cash. What makes me cautious is the price relative to the 2029 earnings that are already embedded in the valuation somewhat. At around 220, investors are already paying roughly 20 times the current consensus estimates for 2029 earnings. For the current price to produce a strong return, I think one of the two things needs to happen. Earnings have to materially beat today's 2029 consensus, and it looks like they will, or the market still has to value Nebius at something closer to 25 or 30 times earnings several years from now. Now that is the valuation question that I would focus on currently. Would you pay around 220 for Nebius based on what analysts expect in 2029? And what multiple would you use? 20 times, 25 times, 30 times? Let me know below and subscribe for more company valuation breakdowns.